Hi, I'm Kara Murphy, and this is Money with Murphy. While markets around the world had a strong finish to the third quarter, it certainly wasn't a smooth ride. Through the unwinding of the yen carry trade, to Fed rate cuts, to geopolitical tensions flaring in the Middle East, and everything in between, markets managed to finish off the quarter stubbornly strong. So let's dive into some of what's happened. Year to date, every major asset class has enjoyed healthy returns. While the S&P 500 is up over 20% so far this year, non-US stocks, bonds, commodities, real estate all made solid gains. And these gains come on the heels of strong returns in 2023. That said, it's helpful to remember that at mid-year this year, the future didn't look quite so rosy. In fact, at the end of July, the unemployment rate ticked up, igniting fears of recession and prompting fierce moves in the market. The panic was so great that some were calling for the Federal Reserve to swoop in with an emergency interest rate cut, something that policymakers have typically saved for crises like COVID. In response, investors sold many of the large cap stocks that had done well to date and instead bought small cap stocks. The chain reaction continued in swift succession across global markets as investors sold US dollars in favor of Japanese yen, otherwise known as the unwinding of the yen carry trade. While we might save the details of that move for another time, suffice to say that the level of volatility in markets around the world was quite extraordinary, though ultimately short-lived. By September, Fed officials were ready for their first interest rate cut since COVID and dropped the overnight rate by a sizable 50 basis points, or a half a percentage point. That marked the beginning of what is expected to be many more cuts. Encouraged by the Fed's rate cut, the bond market largely rallied and the Bloomberg Aggregate Bond Index rose. Treasuries, corporate bonds, high-yield bonds all saw solid gains. Overseas markets had their own events to deal with. In an abrupt reversal, Chinese equities rallied sharply in September after the government announced a massive stimulus program designed to resuscitate the economy. In the third quarter alone, the Hang Seng Index gained nearly 20% after several lackluster years. Meanwhile, conflict in the Middle East heated up as we approached the one-year anniversary of the Hamas terrorist attack on Israel. U.S. markets have remained largely unaffected by the conflict, and even oil, which often rises in the face of global conflict, fell during the course of the third quarter over concerns about softening demand for the commodity. With the third quarter now in the rearview mirror, the next few months will have no shortage of their own market-moving events. October is generally one of the most seasonally volatile months of the year. A presidential election looms, and the Fed might have more rate cuts up its sleeve. We'll continue to keep you updated. So until next time, invest wisely and live richly.